In this week's video, we'll cover a signal that has only occurred 10 other times in the last 35 years. We'll cover this signal from a historical perspective, and then we'll use the same mechanics to review numerous 2016 charts and markets. The analysis will provide us a great deal of insight into the market's current tolerance for risk, as well as market expectations related to the Fed. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In terms of defining the signal that we'll be covering, we're looking at a weekly chart here. We're using generic moving averages, the 30-week, the 40-week, and the 50-week. This is the 50-week, the green, the 30-week is in blue, and the 40 right in the middle, 40-week is in red. In this case, a full-bore bullish look where the probability of good things happening is higher is when the fastest moving average, blue, is on top and the slopes of all three of the moving averages are positive. In this study, our bullish signal only gets negated when we move to a full-bore bearish look, which is the fastest moving average, blue, on the bottom, and the slopes of all three moving averages are down. Therefore, as we review the charts, this is the look we would like to see from a bullish perspective, and this is the look that we would like to avoid from a bearish perspective. And this is how we will evaluate the signal. This is 1982, where my cursor is. Again, we're looking at the same weekly chart with the 30-week, the 40-week, and the 50-week. We get the full-bore bullish look here. Blue is on top, and the slopes of all of the moving averages are positive. Once we get that, in this study, we're counting the number of weeks it took the market to reach a high before we had a bearish signal that negated the bullish signal. So in this case, we're counting from this bar here to the highest point here. And in this instance, after the signal came, the NYSE Composite Weekly rallied for 49 more weeks, or an additional 49-week rally after the signal. We'll show a summary chart, so we'll move through this quickly. Full-bore bullish look here, 144-week rally in the stock market until we have a full-bore bearish look that negated it. Similar situation here, 1988, 1990 NYSE weekly. After the signal was in place, the market rallied for 60 weeks. Fast forwarding here, this is 1990. We get the bullish signal in here. We had a very, very long-term rally based on a strong trend. In this case, the market rallied for an additional 144 weeks. This is 1991. We rallied in 1992, 1993, and into 1994. The signal helps us ignore volatility to ignore, volatility to ignore, volatility to ignore. Why are we ignoring it? Because it's within the context of an established bullish trend. Similar to the present day, we get a long-term sideways consolidation on the weekly chart. This is 1994. This is 1995. We get our full-bore bullish look here. The market rallied after the long-term period of indecisiveness for over 4 years. The rally lasted 1995, 1996, 1997, and into calendar year 1998. Volatility to ignore, volatility to ignore, volatility to ignore. It should be noted, there are numerous weeks here that are red. Therefore, in order to capture the long-term trend, it's extremely important to hold our winners as long as the math says the trends are still in place. As we know, it's not unusual to get long-term and sideways consolidation here. This is calendar year 1999, calendar year 2000 here as the dot-com bubble is starting to burst. We get a full bore bullish look here on our signal. We rally for an additional 21 weeks on the NYSE weekly. Are these signals, or can trend following techniques be helpful when the inevitable bear market finally comes? The answer is yes. Here we get the full bore bearish look. We never convert back to a full bore bullish look for over 2 years as the stock market gets hammered in calendar year 2001, 2002, and really into the early spring of 2003. Just as trend following techniques can be helpful during the painful bear market, they can also help you redeploy your capital when the odds start to improve. We get the full bore bullish look in this region here, and after that point, we never get a full bore bearish look for over 4 years, 2003, 2004, 5, 6, and 7. Volatility to ignore, we still have a full bore bullish look. Volatility to ignore, volatility to ignore. Can't emphasize enough, look how long this painful exercise here goes on. This is a correction that lasts several months, a correction that lasts several weeks. Both of them occur within the context of a long-term rising and bullish trend. All good things must come to an end, and eventually we do flip back to a full bore bearish look here early in calendar year 2008, and it was very, very helpful in terms of assessing probabilities as the NYSE composite got hammered here in calendar year 2008. We never crossed back over to a full bore bullish look until calendar year 2009. Sometimes after a sharp drop, it takes markets a while to right themselves, and in this case we get the full bore bullish look, and we get a rally that lasts 32 weeks after we get the bullish signal. This is the type of situation we're all too familiar with. This is a long-term consolidation pattern. This is calendar year 2010, 2011, and into 2012. Here we flip back to a full bore bullish look after we get a bearish signal out here. The rally lasts for 19 weeks to this peak here. Notice our moving averages and price are consolidating and going sideways here. I can draw a line on the weekly chart from the summer of 2012. Price is here intra-week. It goes back to the exact same spot that it was in November of 2010. We know the longer that we go sideways, the bigger the move that we typically get. What we don't know is whether or not we're going to get a bullish breakout to the upside or a bearish breakdown to the downside. But trends in the indicators should help us. And in this case, after the market went sideways for 18 months, the resolution was to the upside. The longer we go sideways, the bigger the move we can expect to get. In this case, after we get the full bore bullish look in this region here, the NYSE weekly rallied for an additional 148 weeks. Volatility to ignore, volatility to ignore, volatility to ignore within the context of this signal that we're using here. These are generic moving averages. Our market model uses these concepts, but it does not use these particular moving averages. We're using them for illustrative purposes only. If we fast forward into calendar year 2015, we almost get a full bore bearish look here, but the slopes of the moving averages never roll over when blue is below green and red. The bearish signal finally comes here in the second half of 2015, and as you might guess, last week, as of last Friday, now we have flipped back to a full bore bullish look where blue is above green and red, and the slopes of all three moving averages are up. This chart here is as of August 18th, 2016. What does this signal tell us? Does it tell us what's going to happen next? Absolutely, positively no. It speaks to probabilities. When we get this look, the probability of good things happening is higher. For example, here are the bullish signals that we've just covered. This is 1982 here. This is 2016. So historically, under what we've defined in this video, there have been 10 prior full-bore bullish looks after the market gave us a full-bore bearish look. How long did the market rally in each case? 49 weeks, 144 weeks, 60, 144, 235, 21, 225, 32, 19, and 148. All of this here speaks to probabilities. The probability of good things happening is higher. Historically, good things did happen during this period we're studying, going back to 1982. That doesn't mean good things are going to happen in 2016. How do we use it? As long as the signal is in place, then we give the bullish case the benefit of the doubt. If the signal is erased and we flip back to a full-bore bearish look, which absolutely positively could happen, then we will make the necessary adjustments. As of August 19th at 10:58 a.m., we still had the 11th full-bore bullish look. One of the hallmarks of a good trend following or risk management or portfolio management system is your system should work equally as well in numerous markets. You should be able to use it in the currency market, the bond market, use it with commodities, or the stock market. Therefore, we should be able to take our hypothetical moving averages that we're using for illustrative purposes only, the 30-week, the 40-week, and the 50-week in green, and see how numerous markets look in 2016. So what are we looking for? If a market is bullish, this is what we want to see, a full-bore bullish look. And if a market is bearish, it should look like this. This speaks to the probability of good things happening being higher, and this speaks to the probability of bad things happening being higher. So how do markets look in 2016? We just covered that the NYSE weekly now has converted back to a full-bore bullish look. It's the same moving averages, the S&P 500 weekly, Friday, August 19th at 1:22 a.m. We do have a full-bore bullish look. Not too long ago here in late 2015 and early 2016, we had a full-bore bearish look. Why do we care about this from a risk management perspective? And how does the present day compare to, let's say, a poor period like 2008? These are the exact same moving averages in calendar year 2008 for the S&P 500. The look that we had going into February of this year is the look that we want to avoid from a risk-reward perspective. And as you can see, if this is what we want to avoid, the present day, as of Friday, August 19th at 11:22 a.m. Eastern, this looks nothing like this. This doesn't tell us what's going to happen next. What it tells us is the probability of good things happening, given the information that we have in hand now, is higher right now than it was here. It doesn't tell us how long this is going to last, but we manage against facts, not against a very, very uncertain and nearly impossible to predict future in the global financial markets. The slopes in the present day, these are sharp and steep slopes indicative of a strong bullish trend. This is not a sideways look anymore. This isn't a consolidation look anymore. This is a stronger conviction look. The longer this type of look holds, the better for the bullish case. Same exact moving averages, technology stocks. In this case, we're using an ETF. VGT is the symbol. It is converted back to a full-bore bullish look, and you can make an argument that it just had a bullish breakout from a long-term consolidation box. Did we ever get a look like this in the NASDAQ during the dot-com bust? This look would be a steep slope for all of the moving averages in a full-bore bullish look. The answer, no. Here are the exact same moving averages for the NASDAQ Composite calendar year 2000 into early 2003, we never have a full-bore bullish look similar to the one that we have in August of 2016. You can also see the breakout from the long-term consolidation box. Moving averages, just like price, can break out as well. Why do we have price removed from these charts? Because price can be extremely volatile, unnerving, and confusing. It's much, much easier to look at the moving averages in isolation. Moving ahead, helping us assess risk in the present day, Friday, August 19th at 11:29 a.m. Eastern Time, the Dow Jones Industrials too have converted back to a fairly convincing and steep slope full-bore bullish look. Contrast this look to this look here in the second half of calendar year 2015. Did we ever see a look like this during the financial crisis bear market? The answer is a definitive no. In fact, calendar year 2008 into the low in March of 2009, the moving averages never even tried to turn up in any convincing manner. This is a strong, bearish, and high-risk trend. We can see this here in 2008. We can see that the probability of bad things happening is higher, just as we can see the probability of good things happening is higher here, just as we could at the 10 prior instances. I can see the bullish moving average crossover, then we rally for an additional 49 weeks. I can see the bullish moving average crossover here before the market rallies for an additional 235 weeks. Now we're back to Friday, August 19th, 11:32 a.m. Eastern Time. Financial stocks, we do not have a full-bore bullish look, and you can make an argument, that's bad, that's bearish. Well, you can also make an argument that XLF and financial stocks would prefer the Fed to raise interest rates. Higher interest rates helps them with interest rate spreads on loans, and it helps their profitability and their margins. Therefore, the fact that XLF or financial stocks are laggards tells us that the market does not have high expectations relative to the Fed raising rates multiple times anytime soon. Said another way, this chart aligns with the Fed keeping rates lower longer. Similar situation here. Real estate investment trusts pay high dividends. Thus, they have bond-like characteristics. If the market expected the Fed to raise interest rates multiple times in the next 12 to 18 months, it is doubtful that interest rate sensitive and dividend-paying real estate investment trusts would have a convincing and strong full-bore bullish look as of 2:38 p.m. on Friday, August 19th. Everything that we just said about REITs and being interest rate sensitive also applies to IEF. This does not look like a trend that is anticipating multiple Fed rate hikes. Obviously, if those expectations change, it will be reflected in the hard data. Remember, earlier in the year, we wrote that everything changed in terms of the way the Fed was looking at interest rate cycles. You can see the change here reflected in market behavior. The market doesn't know in here for TLT, long-term treasuries, what the Fed is going to do. Are they going to hike rates several times as they do when they follow their traditional late cycle script? Or are they going to be concerned about the enormous amounts of debt in the global financial system? And are they probably going to keep rates lower for a longer period of time? Once the Fed signaled lower rates for a longer period of time, the market got the message, and we moved away from sideways consolidation to a strong trend in TLT. Everything that we've said about the other interest rate sensitive sectors also applies to U.S. large cap stocks that pay dividends. This doesn't look like a market that's concerned about multiple rate hikes. Remember earlier in the video, we said a good system should be portable to multiple markets. It should also help in different bear markets and bull markets. Remember earlier, we showed that the S&P 500 in the present day is on a full bore bullish look. This, in contrast to the present day, is what the exact same weekly moving averages looked like in early 2001 here, and you can see they were very, very helpful during the dot-com bust. We never see this look here. Blue is on top. Red and green and blue all have positive slopes. That never occurs after the bearish moving average crossover here in the year 2000. During the entire bear market, it's telling you that any counter trend rally, in this case, was volatility to ignore within the context of an established and ongoing and high-risk bearish trend. We know the S&P 500 has a full-bore bullish look. What would happen if I was trying to short the S&P 500 today using SH? How do the odds look there? The answer is not very favorable. We have a full-bore bearish look with blue, the fastest moving average, on the bottom, and the slopes of all three moving averages are down. In fact, the fastest moving average, in fact, all three moving averages have broken out of a consolidation box and gone on to make a new lower low. This is SH as of 12:03 p.m. Eastern Time on Friday, August 19th. Similar situation with the volatility index. You can see this is what fear looks like here between August of 2015 and when the stock market starts to bottom here in February of 2016. You can see it's starting to roll over. The volatility index, this is a fearful look here, a full bore bullish look for fear. Now we have a full bore bearish look for fear, or more importantly, or more realistically, the expectation for future volatility in the stock market. How does this look here compare to past bear markets where fear was spiking? This is a full bore bullish look for fear here in the second half of 2008. We know the stock market plunged in the second half of 2008. So if we own stocks, this is the look that we want to avoid for the VIX. Blue on top. The slopes of all three moving averages are positive. We have just the opposite today. We have blue on the bottom, and the slopes of all three of them are down. Some new trends that may be developing. August 19th, Friday, 11:39 a.m. Energy stocks XLE is the symbol. In the ETF world, we just converted from a full-bore bearish look to now a full-bore bullish look using our same weekly moving averages. This doesn't tell us anything about what's going to happen next. It just tells us about probabilities of good things happening relative to bad things happening, and the probabilities are improving based on the facts that we have in hand. Similar situation with economically sensitive material stocks. Full bore bearish look here in 2016, and now we've converted to a full bore bullish look. Did we see anything like this during the horrible periods and sell-offs in 2008? The answer is no. When the stock market started to really roll over in the second half of 2008, this chart converted to a full-bore bearish look. This look here doesn't look anything like the present-day look on Friday, August 19th. Similar situation with emerging markets. In this case, we're looking at VWO in the ETF world. It too has consolidated and it's trying to turn back up. And we have facts in hand that are now aligning with a full-bore bullish look after converting to a full-bore bearish look in calendar year 2015. Sometimes it can be helpful to look at risk on versus risk off. How about if I compare VWO relative to shorting the S&P 500? You can see it has a full-bore and convincing steep slope look in favor of emerging markets over shorting the S&P 500. Do we ever see a look like this within the context of calendar year 2008? The answer is a definitive no. This is January 1st, 2008. You can see back here my moving averages are sideways. We're consolidating. We don't have anything on this chart anywhere, 2008 into 2009, that has blue with a steep and bullish slope like this above red and green. Could this morph into something like this? Absolutely, positively yes. But that's a forecast, and we make decisions based on the facts that we have in hand, and these are the facts that we have in hand on Friday, August 19th. We've talked a lot in the past few months about the excessive debt in the global financial system, and the choices are basically to default, to extend and pretend, or try to inflate away the debt by depreciating your currency. The gold market seems to think that the U.S. will try to depreciate away the debt via a reduction in the value of the U.S. dollar. Even Alan Greenspan has admitted in a public forum that if debt levels get too high, the United States can pay any debt it has because we can always print money to do that. So there is zero probability that the United States will default on its debt. Central banks are a powerful force, and the best way for them to deal with those debt burdens that we've outlined in the past is to try to inflate it away. The markets are sensing that, and that's why things like gold and materials and energy are starting to try to turn along with small caps. Gold, August 18th, 2016, converted from a full-bore bearish look early in 2016. When the Fed shifted gears, the market sensed it and flipped over to a full-bore bullish look. You can see even economically sensitive small caps are trying to complete a full-bore bullish turn here as of Friday, August 19th. We don't have that full-bore bullish look yet because blue needs to clear green here, but we do have the slopes of all three moving averages moving from bearish, bearish, bearish to bullish, bullish, bullish. Did we ever see anything like this within the context of a counter-trend rally during the financial crisis calendar year 2008? The answer is a definitive no. During a counter-trend rally, the fastest moving average was able to turn back up, but from January 1st, 2008 into March 9th of 2009, green and red never even made a serious attempt at telling us to look at small caps. Compare and contrast this look with the present day look where all three of the moving averages have turned back up. Clients and regular viewers know that we've been looking at this inflection point situation. Notice here the 61.8% retracement in 2008. Now we're looking at the 20 all the way out to the 50-week moving average. We're just using generic weekly moving averages for illustrative purposes only. These are not specifically used by the CCM market model, but the concepts are used. Notice during this counter trend rally here, the slopes of all of my weekly moving averages for the most part remain down. After that, really bad things happened. Contrast that with this consolidation here, where eventually within the consolidation box or period, our moving averages start to turn up, and eventually we go to a full-bore bullish look where the fastest moving average is on top, prices above all the moving averages, and the slopes of all of them are up. What do we have today? Do we have something that looks like this or this? The answer is easy. We have a full-bore bullish look where the fastest moving average, blue, is on top. All of the moving averages now have positive slopes and prices on the top. The probability of good things happening was higher here. The probability of good things happening was lower here. We also know that if this was the beginning of a bear market, then we might expect price to struggle around the 61.8% retracement after the first decline. It's not what we have. We did struggle near the 61.8% retracement, but now we've cleared it, and once we've cleared it, we've remained above it. This is just like any other breakout. The longer the breakout holds, the more relevant it becomes. This is telling us from a probability perspective that our indecisive look, much like the moving averages, the indecisive look appears to be breaking in the bull's favor. We know the S&P 500 has just moved to a full-bore bullish look, as has the NYSE Composite. From a probability perspective, why is that relevant? A better way to phrase that might be, how long did stocks rally after the historical signals? So we have the signal here. It's happened 10 other times if we go back to 1982. The answer to the question, how long? The average rally lasted 108 weeks, and the median rally after the signal, so after we could see the signal and the model could measure it, the median rally was 102 weeks. Can't be emphasized enough that this analysis is not a forecast, simply talking about probabilities. What we know when the market closed and we get ready to head into the weekend on Friday, August 19th, that the information and the facts that we have in hand are telling us to hold our current positions based on the probability of good things happening relative to the probability of bad things happening. We also know when we wake up next week that the market will process new information, and if this bullish look that we have in hand here morphs into a bearish look, then we will take appropriate action. Remember last week we talked about the market wizards. What do the market wizards have to say about using hard data, such as the bullish cross that we have in hand, relative to making investment decisions based on our own personal views? I learned that an opinion isn't worth that much. It is more important to listen to the market. I became a reactive trader as opposed to an opinionated trader. It's pretty much inevitable whenever we show something like this that we'll get a small sample size tweet. And that basically misses the point. This video has nothing to do with this signal. We don't track this signal. We don't use it. This video has to do with trends and trend following. The reason why we chose this particular signal is that it helps us illustrate basic concepts about trends. We could use numerous indicators or ways to monitor trends. When you get a bullish trend, they all basically tell you the same thing. Therefore, go take any market that you're concerned about and put some moving averages on it. See what they look like today and see what they've looked like in the past when the probability of bad things happening was higher. So you know what those periods are. Go look and see what happened in 2001 and 2008 and compare those moving averages or indicators or trend following signals to the present day. This video isn't about a rare signal. It's about trends that are trying to turn back up, and it really doesn't matter how we monitor them or measure them. We're going to get all the same results. The probabilities are improving. The probabilities are improving. The probabilities are improving. And in 2016, mathematically, the probabilities are improving. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.